I'm Gary Venner, CEO of IFA Acquisitions, and I'm joined by Anand Senior Tax Manager of Haines Watts, who are one of the top 15 chartered accountancy firms in the UK with over 50 local offices, where we continue our informative question and answer series on our YouTube channel to provide insights into helping buyers and sellers understand the benefits of using brokers for the purchase and sale of IFA businesses, and also from using accountants for sound tax planning advice. The title of the next video is coming up on the screen now. So Anand, selling an IFA business can have different tax treatment. It's really dependent on the way the business has been set up, whether that's a sole trader, a partnership, a limited liability partnership, or a limited company. So I'd like to sort of ask you a little bit about each of those entities and the differences, particularly if they qualify for business asset disposal relief.
Yeah, thanks, Gary. As you say, you get different varieties of business set up. So if you have a sole trader business and you have a partnership business and an LLP business, essentially they're all, from a tax point of view and a business asset disposal relief point of view, they're the same. So essentially what you've got there is someone selling something that's unincorporated for tax purposes, because a limited liability partnership is transparent, which means that actually the partners pay the tax, the capital gains tax, as well as as you would do in a partnership and an unincorporated sole trader. So there you'd be selling your business, including your goodwill. So as long as your business has been running for at least 2 years and you're selling everything, essentially you're retiring, then in broadly speaking the first £1 million of gain is then subject to the business asset disposal relief rate of 10%. This assumes, again, you've never sold any businesses previously, because that £1 million is a lifetime allowance.
Sure. Okay, well that's really interesting to know. And are there any other sort of criteria that HMRC set out for the business asset disposal relief over and above the 2 year?
Well, so no, in terms of sole traders and partnerships and limited liability partnerships, that's the criteria because of the nature of the business.
Right.
For a limited company, it's different.
Okay, so talk to us about a limited company and how does that differ?
So that differs because that requires you to be working in the business for 2 years, which of course you would be as an unincorporated business. It's your baby.
Yeah.
But yeah, so you would be required to work for the business as well as being at least a 5% shareholder.
And I think that's an interesting point that you just mentioned, because of course on some businesses you may have husband and wife owning the shares, but not necessarily one of the parties being working in the business. So how do they get around that?
Yeah, absolutely, and there's a situation we've come across quite a few times, and really what you do is if you make the non-involved spouse, if you like, if you make them an office holder, which means either director or company secretary, then that gives them the requirement to be working in the business. Again, they've still got to do it for 2 years, so it's one of those scenarios.
It's planning, isn't it?
It's planning. It's about as you will know from your point of view, and we have dealt with from our point of view, the best way to deal with a disposal is to have that framework, have that idea to look ahead as to what you're planning to do, because that you can put these things in place. And as you say, if you can make it that your spouse is in the business and is a shareholder, then you've got another £1 million worth of business asset disposal relief available.
Sure. Okay, and that's really useful to know. Going back to, let's just say, a sole trader. That may be a registered individual of a business, but owns their own clients and actually has a business within a business, but to all intensive purposes may be going out to their clients and talking about they represent the IFA business they're part of. Is there any sort of situations there where business asset disposal relief would not apply because there's concern that the clients aren't owned by that individual for goodwill purposes?
Yeah, I mean, you're absolutely right. You've hit the nail on the head. At the end of the day, what HMRC would look at when a business is being sold is what is being sold. So if the legal contracts in place do not stipulate that the RI owns the client base, then you end up in a sticky situation potentially where HMRC will come along and say, this should be employment income potentially.
And I'm assuming that as long as the company that individual is working under are happy to clarify that position, that the RI indeed does have client ownership, I suppose that would get around that as well.
Absolutely. I mean, and as you would say, normally the relationship between the two should be cordial enough to allow that, and certainly this is again the point about having these things sorted out before you're contemplating a sale. You would expect that,
or even going into those contracts in the first place.
Exactly.
It is important, isn't it, to think about so many years down the line as well.
Exactly. How does it look? As much as a lot of business relationships can be quite informal. Is one of those classic situations where, of course, you'd want it as much as possible written down, made it clear as to who owns what, because it's going to help you in the long run to secure your BADR.
So Anand, if one or more shareholders wants to sell their shares and retire, are they entitled to receive business asset disposal relief in the same way as if the whole business was sold?
Yes, potentially. So there's in the tax legislation, there's an avenue for one retiring shareholder to achieve a business asset disposal relief. It's basically the share buyback provisions. It's a bit wider qualifying criteria than this simple sale of the business and owning it for 2 years, because actually for a share buyback you need to have owned it for 5 years, your shares, and the buyback has to be for the benefit of the trade. And actually retirement is is one of the criteria that HMRC accept as being for the benefit of the trade. But absolutely, one departing shareholder can indeed achieve business asset disposal relief.
So in terms of business asset disposal relief, I know that HMRC are not going to allow all of that sometimes to qualify. Help me out here with what can an IFA expect the HMRC to actually agree here?
Yeah, you're absolutely right. I mean, one of the qualifying criteria for any business to achieve business asset disposal relief is it's got to be a trading business.
Yeah.
And cash balances are looked at as potentially as a non-trading asset, which actually, if the cash held in the business far outweighs the rest of the value of the business, you completely lose business asset disposal relief. It's an all or nothing, if you like.
Yeah.
HMRC use a criteria looking at 20% of the asset base and management time in managing those funds. They'll look at that. That's a sort of 20% threshold they'll look at.
And this is sort of 20% of the annual turnover, is that right?
Of various things: annual turnover, income, management time.
Yeah.
Various things. It's one of those areas in tax where it's the picture in the round rather than necessarily a tick list. So one of the things that a well prepared founder can do, or if they think their cash balances are getting a bit high, getting towards that 20%, is they should have that documented in the board minutes as to why they've got cash balances. Because actually, if you can say that you need it for business purposes, that you've got it earmarked for something, then that will be that'll be helpful in explaining as to why these are actually trading assets. They haven't completely turned to an investment asset.
Yeah.
So that is.
And I'm guessing also for working capital requirements as well.
That's exactly the area that I'm referring to. So that is what they would want to do.
Fantastic. So, Anand, if somebody doesn't qualify, a business for business asset disposal relief, is that the end of the road, or are there even other schemes that can be considered, to minimise that capital gains tax liability?
Yeah, absolutely. So, for one of the options available, if there's no acquirer in the offing, or potentially if the individual has just decided that the business owner decides they want to sell, they could actually sell essentially to their employees via employee ownership trust.
Okay.
And what's really powerful in EOT, as they're called, is essentially it's a capital gains tax-free exit for the shareholder. And the consequence is that essentially the shares get sold into trust for the benefit of the employees. And so the reason why this is so attractive is because it's essentially infinitely flexible in terms of you've decided that you want to sell. You're going to get your capital gains tax free, and essentially you could get paid out from future profits of the business. Similar to what you might do in a management buyout, but in this case it's an employee ownership trust. Again, it's one of those areas which is highly prescriptive, and we'd always say approach HMRC for clearance to make sure that you're doing it for bona fide commercial reasons. Clearly the individual can't then have an interest in the trust, because that would go against the spirit of the legislation. In fact, that would go against the rules in the legislation. So whilst the individual doesn't have to sell all of their shares into the employee ownership trust, they'd have to sell at least 51% in order to get this CGT free. So they can retain, be a shareholder outside of that and still be involved in the business. It doesn't stop them being involved. So some people might look at that as a step to semi-retirement potentially. But the idea and the whole rationale behind it is you want your management team or your employees generally actually to continue running the business and have their stake in the business via the employee ownership trust.
Well, I think that's enlightening, that what you just told me, because I didn't know that existed, and I think this is true of many IFAs looking to sell, not always aware of other schemes that may suit them. So again, it's good that you are the experts in this field and can consider, and I'm guessing it won't be for the majority. It's only going to be for a small minority. But again, it could actually be a very worthwhile way of extracting yourself from the business.
Yeah, it depends on the circumstances, but again, for the individual, the main owner, founder, shareholder, it allows them to control their own destiny. Now, of course, the other side of the equation, where there is risk, where someone may decide it's not appropriate for them, is of course it depends on the health of the business as to how much they get paid for it. Because we touched on it earlier about deferred consideration. Now, clearly, if you're selling your shares to this employee ownership trust, it's worth a certain value. Unlikely that the company will have the money to pay for it up front, so you'll have deferred consideration. And of course, if that business, without you being as involved, is not as successful, there's a risk you've sold your company for less than you might have got to a third party. So there's always commercial risks, but as you rightly say, there are advantages to doing it if it fits the circumstances.
Make sure that you subscribe to our YouTube channel and switch on notifications so that you won't miss our next video in this series. We provide insight into the tax planning benefits for an exit or acquisition of financial advisory businesses, as well as the benefits of using brokers by two industry experts, me, Gary Venner, CEO of one of the UK's largest specialist brokers in IFA Acquisitions, and Anand Chandarana, Senior Tax Manager of Haines Watts, one of the UK's top 15 chartered accountancy firms.